Vineet Bhatnagar, MD at Phillip Capital. Vineet, hi, morning. It's been a tumultuous series for the markets. Do you think we'll manage to close around the 5200 mark, or could it get more worse in the next few days?
I think for the present moment, for the next few trading sessions, there seems to be a capitulation of the market that has happened yesterday intraday. We were quite focused on the level of 5210 on the closing basis before the market opened yesterday, and while the market did make a new low far below that level intraday, it did close quite smartly in the last few trading hours yesterday. We think that the expiration today could come around 5200 to 5250 level, unless the lift up in the local currency market actually has a salutary effect even on the equities, and it closes above 5300.
That's the big story, and the big story is rupee has recovered, and rupee has recovered by about 2.7%. Yesterday the reverse trade was at play. Rupee started gap down. Today rupee in fact has started gap up, and it is staying there, and I don't think banks or Reserve Bank of India has intervened. This is really an oversold, broken down currency which clearly seems to be making a comeback. Vineet, if rupee has strengthened the way it has strengthened today, do you think now IT stocks could reverse?
I don't think so. I think what we have seen in the last 48 hours, which was quite dramatic on the downside for both the equities and the rupee, was also resulting in a consensus opinion on rupee being really highly oversold or undervalued. It was therefore more a situation of a crisis relating to the confidence in the markets as against anything else. Reserve Bank of India, having stepped in yesterday, is perhaps showing its impact on the rupee this morning. However, in the near term to medium term, the external factors, whether it be the crude or whether it be even the precious metal price movement, continue to remain the way they are, which is on the upside. Domestically, also the twin deficit. Twin deficit program that we are running over here has also not changed overnight. So structurally nothing has changed. It is just a change in the sentiment, and the crisis and the confidence crisis that we were all facing seems to have reversed. So there is no reason for us to believe that the IT related strength that we have been noticing will reverse quickly.
Vineet, would it be prudent perhaps to start taking some amount of profits off the table when it comes to IT names?
It depends upon the outlook that you have towards your book. If it were trading positions that one has taken, which was in relation with the ever continuing depreciation in the currency that one was looking at, I guess it may be possible for one to book the positions. But if one is, however, looking at a near term or the next 1 quarter or so kind of a position, then there is no need to actually book the profits yet in the IT, because that surely would continue to be the best defense that one has in an otherwise uncertain currency market situation.
How would you approach banks then, Vineet, considering the kind of damage we've seen in the sector? Is there any stock from the PSU or the private banking lot which is now a buy purely because of the valuations that they're quoting in? And also, what trade would you look to execute in the Bank Nifty futures?
Bank Nifty futures, unfortunately, the kind of mayhem it has seen has actually witnessed an above average rolls on the short side, even till last night. So there has been a consensus call on the continued damage to this particular sectoral index for some time now, and I guess that would continue to be a problem because it is linked to the bond portfolios of some of the large private banks. But if you were to ask me as to what is a trade that we would like to do, it will be buy HDFC Bank.
Vineet, whereas everyone on the street is drawing a parallel between 2013 and 1991, should one also focus on that what happened to stocks after 1991? And for those who bought stock in 2008, 1991, 1998, they made serious money.
Yes, of course. I mean that really depends upon the appetite as well as the outlook that one has. So while clearly times such as these would have and would bring aggravated pains, as we have seen in the last few days, as a dramatic change to the outlook and the confidence and sentiment. If one is serious about putting together a portfolio with the long-term view of 5 to 7 years, there are serious names and quality names that one should continue to focus on in terms of putting putting their money behind that. It is too simplistic to look at a chart and try to draw parallel between a 1991 or a 2013. 1991 was a completely different kind of regime in terms of the exchange rate management that we had in India, and 2013 is different, and therefore all of us have been under severe shock on the currency front, because we have never had a currency regime the way we have had in the recent times. So this kind of aggravation or this kind of short-term pain is something that one needs to be able to withstand. If one is able to withstand that, and for institutional managers, if there is a mandate from their investors to continue to look at a market like India with a 5 to 7 year horizon, yeah, this is the time perhaps to start looking at building the portfolio. Not necessarily putting all the money right away, but over the next quarter or so, definitely.
Vineet, what happens then to metals? Do they continue to outperform? In bits and starts, we've been seeing moves in a couple of the cap goods names, one case in point being BHEL. Would that trade last?
I think it is again so much linked to not only the international prices, but also the construction related demand. In our particular situation, it could perhaps have a bearing on the outcome of the discussion relating to mining. So names like Sesa Goa will have a positive lift up on the back of an event itself. Tisco is looking all right. Sterlite and Sesa have gone through a corporate action just this particular month. So yes, this is a space that has done well in terms of the short-term performance that we have seen, but one has to be more sensible about what factors, internal, news-based or external, would have on specific metals and therefore stocks as far as we are concerned as a market.
Vineet, a 5 to 7 year time frame for some of our viewers could be a lot. That's like one generation. Let's talk about next 1 year. Hypothetically, if you and me are engaging on the same forum in a conversation after 1 year, which are some stocks where you think a modest 20% appreciation should be expected? Give me some names.
I think the names would definitely come from sectors such as private sector banks. I would place my money behind names like HDFC Bank, ICICI Bank, Axis Bank. I would look at names, some of the names in the pharmaceutical, which should do well both as a defense as well as some export orientation. Some names like Dr. Reddy's have established for their business model. I would have names from the IT space. I will go for Infosys and TCS. We would go and lean towards FMCG regardless of the valuations that are still visible. So one would look at names like ITC, Nestle, HUL. We would look at some names even in auto sector, which would be symptomatic of a recovery that one is anticipating in the next year or year and a half. So names like Tata Motors should also creep in.
Vineet, let you go on that note. Really appreciate you taking the time out and speaking with us today. That's the view coming in from Vineet Bhatnagar from Phillip Capital.